Very good morning, friends. So it's a lovely Sunday morning, and I think we're trying to make the best possible use of that on an early Sunday morning. So it's a start of the revision of consolidation standards, and I think you're already aware that in terms of the consolidation standards, there are a plethora of standards which we will cover as far as consolidation is concerned. So we've got four dedicated sessions towards consolidation. I think this is another one very important area from the examination point of view because invariably you do get a question on the consolidation. And once we speak in terms of consolidation, the couple of standards which you need to focus on: Indus 103, business combination; Indus 110, that is consolidated financial statements; Indus 28, that talks about associates and joint ventures; Indus 111, that talks in terms of joint arrangements; and of course, a bit knowledge in terms of Indus 27 as well. So, of course, before we start with these standards, what I'm going to do, as usual, we're going to first make some quick mind maps, recall the concepts which are there, and then we'll solve questions with you. So I think the first mind map which always comes to my mind when I revise the concept of consolidation is getting the interconnectivity in terms of various standards. So I'm going to start with the very first mind map, that is in which situations which standards becomes trigger. So let's begin the journey and let's begin with the first mind map for the day. So I am taking the first mind map. So let me keep numbering them as well. Mind map number 1. This mind map is on, I would say, interaction of various standards. It is on the interaction of various standards. Because when you're looking at consolidation standard, then I think one of the most important inputs which should be clear in the mind is which standard triggers under which circumstance. So I think that is the very first focus which comes in the mind. Now, you would recall, if you've taken the regular sessions, that there are basically three focus points. One is we look at what did we acquire. It's either an individual asset or a group of assets. The second focus is that if it is a group of assets, is that a business or not? And once you say it is a business, then the third focus is looking at, did we acquire a control, or maybe a joint control, or maybe a signal influence, or maybe it's a case of a complete passive investment. So I think the three key focus points is in terms of group of assets, which needs to be a business, and there is a control. So we've got the three-step model in terms of just revising this. So the focus number 1, that is in terms of the step number 1, that is focusing on the input, that what did we acquire? What did we acquire? So I think that's a very important question to ask. So I'm just trying to connect the dots as well, because once you're going to revise the entire concept, I think this chart is going to be a baseline in terms of various concepts. So when I look at the step number 1 and I say, what did we acquire? You get the answer that either we acquired an individual asset. Either we acquired an individual asset, or we can say that we acquired what can be called as a group of assets. So either it is an individual asset or it is an acquisition of what we call a group of assets. Now, if it is an individual assets, undoubtedly in this particular case, consolidation standards can never trigger. So in terms of the individual assets, you've got your focus points further, that either it is tangible in nature, or we say that it is intangible in nature. So either you say that it is tangible in nature, or we say it is intangible in nature. Now, when you say that it is tangible in nature, then in this particular case, depending upon the facts and circumstances of the situation, either it could be an application of Indus 16, or Index 40, that is a property, plant, equipment, or an investment property. Because when you're looking at a tangible asset, it could be either a case of PPE or Index 40, depending on the parameters which are met. And if you say it is intangible, then we would apply Index 38. So that's where the role of the individual asset comes in. Now, when you say that it is a group of assets, then in this particular case, it's time to go to the step number 2. So in order to move towards the consolidation standard, what is the focus in terms of step number 1 is that you need to acquire not one, but more than one asset. Now, when we say group of assets, of course, it's inclusive of liability. So it's assets and liabilities. You can say both. So that is a focus in terms of step number 1. Second, so we go to the step number 2. Once you've identified that yes, it is a group of assets, the focus is to decide that is it a business? The focus is to decide that is it a business or not? So that is another focus point to decide. Once you zero down on the fact that yes, it's more than one asset, it's a group of assets, then I think the focus is to see whether it's a business or not. Index 103, tells you the parameters to decide when is it a business or not. So your mind should immediately tell you that, okay, if it is supposed to be a case of a business, there are 2 tests. One is called an optional concentration test, and the other one is called the 3-element test, which we also call it as IPO. The 3 elements being input, process, as well as output. So in terms of deciding whether it's a business or not, just, pen down the thoughts out there. So we've got 2 tests which will help you to decide that parameter. The first test which helps you to decide that, so we can say the first test which will help you to decide that is called the optional concentration test. We'll be talking very soon on this as well. So it is called the optional concentration test. The word option just reminds you that this is a test which is not mandatory in nature. It is a complete choice on the part of the company to decide whether they want to apply this concentration test or not. And the second test is what we call the 3-element test. I also call this as IPO because these are the 3 elements in terms of a business: input, process, output. Now, we'll talk of this revision later. What is the concentration test and the 3-element test? But once you apply these particular tests, you reach a conclusion that it's a business or it is not a business. So accordingly, when you apply these tests, you get the conclusion, yes, it is a business, or you get a conclusion, no, it is not a business. If you say, yes, it is a business, in that particular case, it's time to go to the step number 3. And if you conclude that no, it is not a business, then in this particular case, we can say you do acquire multiple assets, but it is making a consolidated purchase consideration. You're basically making a consolidated PC. You need to go to the valuer. He's going to give you the breakup of all those individual assets. What he's basically going to do, he will allocate the purchase consideration in the ratio of relative fair value. Remember, it's relative fair value because the life of the assets could be different. So there you will need to allocate the purchase consideration, the consolidated amount, you can say in the ratio of relative fair values. It is going to be segregated in the ratio of the relative fair values. Typically, if the life of the asset is similar, then you would land up allocating the purchase considerations in the ratio of the fair values itself. The concept of relative fair value comes into play when the life of the assets are different. Something which you would recall you would have done in terms of Index 36. When you allocate the corporate assets and it is allocated in the ratio of relative fair values, trust me, the same kind of concept would apply, that the segregation of the purchase consideration would be done in the ratio of the relative fair values. After this is done, after the allocation is done in the ratio of relative fair values, then you would apply, depending upon its tangible or intangible, either it is 36 or it is 40 or it is index 38, as the case may be. So I think that is a focus in terms of the step number 2, that what you acquired is a group of assets, but you need to make a test and identify, is that a business or not? Now, once you've decided, yes, it is a business, then the focus turns on to the step number 3. Then the focus turns on to the step number 3, and now you need to decide that did we get control? The focus now is to decide that did we get control over the business? So when you say that in step number 2, yes, it is a business, then the focus is to decide, are we getting a control over the business? Control is again dependent upon the parameters of Index 110. And you know, control assessment is not a rule-based assessment. This is an assessment which is subjective, which is based on the elements of power, which is based on the elements of exposure to variable returns, and it is based on linkage between the power and return. But more or less, from the practical questions point of view, we do presume that if you've got more than 50% voting power in a company, that would indicate the presence of control. But you need to keep in the back of the mind, control is not simply based on a voting power. So in this particular case, when you look at did we get a control, so I would say the focus is, when you say did we get a control, the control assessment is based on Index 110. The control assessment is based on Index 110, and immediately, those 3 factors should shoot into mind. Though that element of discussions will come when we come to Index 110, but in this particular case, the 3 elements in this case is power, then it is exposure to variable returns. I'm putting it as VR, exposure to variable returns, and you need to prove a linkage. And you need to prove a linkage between power as well as return. The linkage between power as well as return needs to be proven. Now, in this particular case, when you look at the assessment of control, the answer comes a yes or the answer comes a no. So when you evaluate this particular aspect, you get the answer either as a yes or you get the answer as a no. Now, when you get the answer is a yes, then in this particular case, we should know that which particular standards would trigger in this particular case. Now, there are a couple of standards which will trigger in this particular situation. I would put it like this, that your conceptual clarity needs to work, that Index 103, which will trigger, is a one-time application. Index 103 will trigger, but that triggers only on the date of acquisition. It applies only once on the deal. But then every year, you are going to make 2 financial statements. One is the separate financial statements of A, that is, for example, A acquired B, because once you establish control, it is a case of a parent-subsidiary relationship. And as a parent, when you get a control of the company, you are required to present 2 financial statements. One is the separate financials and one is the consolidated financials, which is supposed to be an yearly exercise. So the focus points, what you need to keep in mind is that you are going to apply once. You're going to apply once the concept of Index 103. This is going to be applied once on the date of acquisition, because you need to put an acquisition entry in this connect. And then you are going to apply every year. You're going to apply every year. One is Index 27, that is dealing with separate financial statements, and one is the consolidation, that is Index 110, that is consolidated financial statements, and this is business combination. So your mind should be very crystal clear that, okay, there are three parameters which will make you enter the consolidation route. You acquired group of assets, which is a business, and you get a control. So you need to acquire more than one assets group. That needs to be a business, two, and you need to get a control, that is three. Then Index 103 becomes applicable, and these are going to be an annual affair. Now, when you say a no, then there are certain sequence of questions to be applied. If you say a no, then there are certain sequence of questions which you need to apply. If there is no control, maybe there is a joint control. And if there is no joint control, maybe there is a significant influence. And if there is no significant influence, maybe it is a case of a passive investment. But you need to evaluate the concept of joint control as per Index 111, the concept of significant influence as per Index 28, and if neither of them is present, then it becomes a case of Index 109, which is a passive investment, which you have already done. Equity investments, fair value through P&L, not held for trading. You get a choice between FPTPL and FPT-OCI, no recycling, that's enough. So in terms of the sequence, so we can say this would be either a case of a joint control, if not a case of significant influence, if not a case of a passive investor. So depending upon these circumstances, facts of the case, accordingly, a different standard would trigger. So if it is a case of a joint control, then we would apply Index 27, separate financial statements, and Index 111, that is joint arrangements. If it is a significant influence, then it is Index 27 for separate financial statements, and it is Index 28 for consolidated financial statements. And if it is neither a joint control nor a significant influence, then you land up applying the standard on financial instruments, that is Index 109. No consolidations will occur. I think one thing which is worth making a mention is that Index 103 applies only in this circumstance. The concept of business combination standard triggers only in one case, group of assets, which is a business, and you get a control. Once the three combinations are met, you enter the arena of Index 103. So that was a mind map, just connecting the interactions of various standard. So you know that in terms of which particular combination with standard triggers. So now you see 103, you see Index 28, you see Index 110, you see Index 111, the four pillars on consolidation, depending upon the relationship. The control leads to 110, the concept of joint control leads to 111, the concept of significant influence is 28. So these are the three different standards. And 103 is a one-time application, which is on acquisition date. Right, so far so good. I think my first mind map stands done. Now, within this mind map, in terms of the step number 2, we've been talking in terms of the two tests which are conducted for a business. So I think let's take a recap. Let's try to understand, with a quick recap, that what is the concept in terms of concentration test and in terms of IPO, what we call a three-element test. And there has been a very interesting question in the study material on the concentration test as a part of the practice. We'll do that question as well very soon. Let's first take a little quick inputs on that. So let me make my second mind map. This mind map, second mind map, which we are creating is with reference to the test for a business. So we're looking at how do we identify whether it is a business or not. So we're looking at the two tests, concentration as well as the three-element test. So we'll take a quick recap on the inputs. So let me just divide this in two parts. So first thing what we need to understand is that there are two tests which are given in the standard. So one of the tests is called the concentration test, which is optional. So one of the tests is called an optional concentration test. So it is an optional concentration test, and the word itself is indicating that it is completely optional in nature. And the second test is what I call the IPO test, or you call it as a three-element test, one same thing. Now, immediately when you recall the concepts in terms of these tests, your mind should tell you which test is applied when. Now, there are a couple of combinations. The company may choose to apply the concentration test or may choose not to apply. If you choose not to apply the concentration test, you directly go to the three-element test. If you decide, no, I want to apply the concentration test, if you pass this test, it's not a business. No further investigations required. But if you apply the optional concentration test and you fail the test, then again, you need to go to the three-element test. So the clarity which we need to apply out here is there are two combinations. We choose to apply the test or we choose not to apply the test. So either we choose to apply the test or we choose not to apply the test. If you say, no, I'm not applying the test, then this test becomes mandatory in nature. But if you say that, yes, I'm going to apply the test, then it depends upon if you pass the test or if you fail the test. If you pass the test, it's not a business. If you pass the test, it's not a business and no further investigations would be required. But if you fail the test, then also in this particular case, you need to apply the three-element test and that also becomes mandatory in nature. So you can see the various combinations which needs to be clear in the mind. Optional concentration test, you do not apply three-element test. You apply and fail three-element test. You apply and pass, not a business. No three-element test is required. So that is the combination. Now, let's now see in terms of the second input that when I say the concentration test, we're just taking a quick review of the concentration test and the three-element test without getting into too much details. So we are looking at the two tests, a basic input in terms of these two tests, what is required to be done. We'll take a question on the concentration test as well. Now, when you're looking at a concentration test, the basic funda is identification that the purchase consideration is substantially concentrated in a single, or you can say, group of similar assets. Because the idea is to see that, a substantial portion of the purchase consideration is concentrated in a single or a group of similar assets. So I would say there are three steps which you need to apply in this particular case. So the first thing what you need to do in this case is the step number one. You should first of all identify in this particular case that what is that single asset, what is that single asset, or what is that group of similar assets, what is the group of that similar assets which you can say is got the highest fair value. Try to locate as a part of the acquisition. Try to locate as a part of the acquisition that which is that single asset or a group of similar assets which has got the highest fair value. That's like a step number one. Then we need to go to the step number two. And in terms of step number two, we need to get, I would say, an adjusted purchase consideration. Because the purchase consideration is paid for the net assets and it is paid maybe for 80% shares acquired. So what do you need to do in this particular case? You need to consider the purchase consideration. Maybe that's paid for an 80% stake. Maybe a 10% stake was acquired earlier, and then there is an NCI. So you need to take the purchase consideration, add the previously held interest, and add the NCI. That's one thing which you need to do. So you need to take the purchase consideration. So let's say, for example, this time I acquired, let's take different figures. I acquired 40%. And let's say 30% was acquired earlier. That makes it 70. And 30% is with the NCI. So you take this sum total, which is PC 40, PHI there is 30, and NCI there is 30. That gives you 100%. And to this, we need to add back the liabilities, and we need to reduce the cash and the cash equivalents, so that we can indirectly get what is called the gross value of the assets. Because the idea is to calculate, or you can say the convert the purchase consideration in terms of what is paid for the gross value of the assets. So the exercise is simple. You need to add the three elements, then add back the liabilities, and then reduce the cash and cash equivalents in this case. Once you've done that exercise, then you come to the step number 3. And in terms of the step number 3, what do you need to do? You need to consider 1 as a percentage. 1 as a percentage of 2. You will take this value, the fair value of this asset, as a percentage of the gross value, and if it is supposed to be substantial. If it is supposed to be substantial, now there is no definition of what is substantial in nature. But generally we consider that, from an examination perspective, it should be generally around a 90% or more, but this is not a guidance which is given in the standard. So if it is substantial, let's say it's around 90% plus, then you can say that yes, the test is pass. And when you say the test is pass, it is not a business. And if you fail, then you need to go to the 3-element test, that is IPO test. We'll do a question on this as well. Now, coming to the other one, that is called the 3-element test, that is I input, P process, and O output. Now, let's remind ourselves on the basic inputs in this case. When you look at acquisition of a business, in this particular case, the presence of output may or may not be there. Output is represented by the presence of revenue. But acquisitions might take place for companies which are, just startup companies, and they may not have revenue. So standard makes it very clear that the presence of the output, that is the presence of the revenue, is not important. But what is most important is the presence of input along with the process, which needs to be substantive in nature. So you need to look into the fact that there is an acquisition of input, 1, and there is an acquisition of process, that is 2. Process needs to be substantive. Processes could be represented in the form of formulas, or it could be represented in the form of organized and skilled workforce who've got the necessary skill and knowledge with which they will convert the input in terms of output. So I would say in this case, out of the three elements, the presence of input and the presence of output is the most important. The process which is acquired needs to be substantive in nature. The process which is acquired needs to be substantive in nature. They need to be critical, without which the conversion of input to outputs cannot take place. Though we've done a little extensive discussions with reference to the two cases, when the output is not present, how do you evaluate? When the output is present, how do you evaluate? But I'm just making a quick inputs at this stage. So as far as the output is concerned, that is not an essential element in this case. So that was the mind map number 2, getting the insights in terms of how to decide whether the group of assets acquired is a business or not, the option concentration test, as well as the 3-element test, that is IPO. I think now let's do a little practice question with you. I'm now going to do a practical illustration on a concentration test before we take the journey forward. So I share a question on the screen, and this is one of the questions which is there in the study material as well. So let me, I guess, look at the question number one now. Let me just zoom it further. So let's have a look at the question number one. So in this case, again, we're going to cover a total of 20 questions or so, super 20 questions covering the concept of 103, 110, 111, and 28 mainly, the consolidation standards. So let's have a look on the question number one. It says entity A holds 20% interest in B. Subsequently, A further acquires, it says, a 50% interest in B by paying 300 crores. So you can say that 20% is the PHI, and the company has now acquired another 50%, that makes it 70. The fair value of the assets acquired and the liabilities assumed are given. So we given the building, the cash equivalents, the financial liabilities, and we are given a DTL. Then it says fair value of entity B is 400 crores, and the fair value of the NCI, that is 30%, is given, and the fair value of the PHI is also given. And then it says entity A needs to determine whether the acquisition is an asset acquisition as per the concentration test. Now, before I solve this question, because it's not possible to pen down all the thoughts, so I think I'm just also, just going to make some quick inputs without documenting that. Because as you revise, you should also be clear in terms of why is it so important to identify whether it is an asset acquisition or it is supposed to be a business. So you should principally know, two, three differences which are there in terms of accounting for asset acquisition and accounting for a business combination. The first, I think, the difference which pans out is when you say it is an asset acquisition, no goodwill arises on an asset acquisition. But when you say it is a business, then a goodwill or a capital reserve arises on acquisition. That's one key difference. Second, when you say it is an asset acquisition, there are no deferred tax implications. So no DTA or DTL would arise at the time of the asset acquisition. But if it's supposed to be a business combination, then because the assets and liabilities are taken at a fair value, so there will be a difference in the fair value and the tax base of the asset liability. So that could lead to deferred tax implications. That is the second focus point. The third area, which is also important to remember, that when it is an asset acquisition, you do add the transaction cost as a part of the acquisition cost. Any brokerage commission paid gets added to the cost of the PPE. But when it comes to a business, that is Ind AS 103, the transaction cost is supposed to be expensed in the P&L. So I think the three focus points need to be clear in the back of the mind without documenting. I thought I'll just give you the insights. So one is the implications of goodwill, one is the implications of deferred tax, and one is the implications of TC that distinguishes between the two kinds of accounting. Asset acquisition, no goodwill; business combination, goodwill. Asset acquisition, no deferred tax; business combination, deferred tax. Asset acquisition, TC capitalized; business combination, TC is expensed off. That's the real essence, which is important, that the standard sellers have actually decided to pen down and give the industry the guidance in terms of whether it's an asset acquisition or whether it is supposed to be a business combination. Anyway, now let's come back. So we are doing now the question number one, which is on the concentration test. So I think if I just come back on the details and just connect a few dots before we go further, let's have a look. So as I said, the very first step, what you need to do in this case is look at the asset, single or a group of assets, which has got the largest fair value. I guess if you look at the assets, there is a building, there is a cash and equivalents. I think building is the only asset which has got a highest fair value of 1,000 crore. I don't see any similar assets in this case. And then we just need to concentrate on the second step. So let me just begin. Maybe you can take a snapshot of the screen. Otherwise, the question is there in the study material as well. So the first thing what we're going to do is in terms of the step number one. So we can say building is the asset which has got the highest fair value, and that is to the extent of 1,000 crores. Then we go on to the step number 2, and as I said, we basically need the gross value of the assets. So we want basically the gross value of assets. And in order to calculate the gross value of the assets, we can do this in stages. We can do this in terms of stages. And what would be the stages? First, what you can do in this case, you can take the sum total of the purchase consideration, the previously held interest, and the NCI. That is like 1. This converts it into 100%, then add back the liabilities and reduce the cash and the cash equivalents in order to get the gross value of the assets. So if you look at the purchase consideration, so we are clearly given in this particular case that we acquired 50% shares by making a payment of 300 crores. The previously held interest is given to me, it's valued at 80 crores. And the NCI is also given to me, it's valued at 120 crores. And to this we add back the liabilities because we want the payment which is made for the assets. So liabilities is given 800 crores. And the cash and cash equivalents in the question, that is 200 crores. So that's going to give us the gross value of the assets. So this is 300 plus 80 plus 120 plus 800. This is turning out to be 1100 crores. So once you're able to get the step 1 and 2, now you know that building is got 1,000 crores fair value, and what is the gross value of all the assets is 1100 crores. So we can go to the step number 3 and calculate a percentage based on this. So we will simply consider 1,000 crores, the building as a percentage of 1100 crores. And if we take this percentage, 1,000 divided by 1100, that comes to around approximately 91%. That is the percentage. So we can definitely say in this particular case, the building, 91% of the consideration is concentrated in the building, substantial. This is definitely, we can say, is substantial in nature. And since it is substantial, the test is passed. And once you say the test is passed, then it is not a business. Then it is not a business. So I think this is one area which can be, quite well tested. And I think once you're clear in terms of the various steps follows, I think life is simple. So this indirectly, takes care of my input on the introductory part of entering the standards, understanding the step 1 group of assets, understanding especially the 2 tests in terms of business, the application of the concentration test, and then it is all about, the combinations of control, joint control, etc., etc. So now let's, I think, enter into 103. So this was the initial, things to the consolidation standard. Now I think we're going to focus today completely in terms of revising Ind AS 103. So let's begin the journey. So my focus now in terms of revision is Ind AS 103, which is called business combination. Now, as you revise Ind AS 103, your mind should immediately tell you, because by now you know the entire standard. So when you revise, then all the things which you've connected at a later stage should also get interconnected at the very initial stage itself. So there are, 3 different kinds of questions which you will come across in terms of business combination. Either it is a case of, I would say, first of all, broadly, let's divide the discussions into two parts. I would say, broadly, you can divide it in two parts. So I would say broadly, if you look at the entire flow of the business combination standard, it is either a case where you're dealing with unrelated parties, or it is a case when you're dealing with related parties. If you're dealing with related parties, the possibility is that it may turn out to be a common control transactions, provided the parameters of common control transactions are met. That means before and after the business combination, we can say the companies were under the common control, and the common control is not supposed to be transitory in nature. So when you see that a transaction occurs between a related parties, and if the parameters of a common control is met, you would apply the concept of common control accounting. But if the parameters are not met, then you come back out here as an unrelated party. In terms of unrelated party, there will be two kinds of combinations. Either it is a case of acquisition accounting, or if it is a case of a reverse acquisition accounting. When the legal and the accounting acquirer turns out to be the same, it is a case of acquisition accounting. And when the legal and the accounting acquirer people turns out to be different, it is a case of reverse acquisition. So the broader picture, what you need to consider out here is, if I just make a little quick mind map again, that's my mind map number 3. So if I just make a quick mind map at this particular stage, we can say the accounting treatment in terms of business combination. The accounting treatment in terms of business combinations could first be broadly divided into subcategories. So we can say the accounting treatment would be that either you're looking at it is between unrelated party, either it is a transaction between unrelated party, or it is supposed to be between related party. So when you look at a related party, your focus point should be, first of all, to evaluate the parameters. That does it meet the parameters of common control transactions? Does it meet the parameters of common control transactions? And I think personally, the common control transactions where the focus is before and after the business combination, the same parties control, and the control is not transitory in nature. So in this particular case, when you say, does the common control parameters get met or not? If you say yes, they are met, then you apply the concept of Appendix C. So we will be dealing with the common control transactions accounting separately at a later stage once we revise the questions. But the Appendix C to the standard applies in that case. But if you say no, the common control parameters are not met, then you need to evaluate it as good as an unrelated party. So, because when you see a larger question in the exam, it is very important to first of all, filter down and understand that what kind of accounting is applied. Because many students at times, face a problem. So I look at a question and I don't know, where to enter. So I think the first instance to see is the transaction is happening between related, unrelated party. If it is related parties and the parameters of common control is met, you're applying the common control accounting Appendix C. But if the parameters are not met, then you're treating them as good as unrelated parties. And in terms of the unrelated parties, there are two types of accounting. One is called the acquisition accounting. And the other one is supposed to be a reverse acquisition accounting. Now, when you say acquisition accounting, this accounting applies when the legal and the accounting acquirer are the same people. And the reverse acquisition accounting applies when you know that the legal and the accounting acquirer are two different people. So in this particular case, when they're two different people, then this applies. So at the end of the day, we can say that there are a total of three kinds of accounting which is available in terms of Ind AS 103. Just to also give you the connect, that this reverse acquisition accounting is what is applied in terms of Appendix B. And the acquisition accounting, which is given in the main part of the standard. It is given in the main part of the standard. So which gives me the thought process very clear that there are three kinds of accounting which are there, and we'll be discussing each one of them one by one with practice questions. The first is, it is a case of an unrelated party or maybe a related party, but when the legal accounting acquirer is same, acquisition accounting. The second one is unrelated parties generally, but can be related parties. When the legal accounting acquirer is not the same, that's called reverse acquisition. And then there is another input, that is a related party transactions. Here you cannot get unrelated parties when the common control parameters are met and becomes a common control accounting. So we're going to revise the concept of acquisition accounting. Then we'll go to the concept of reverse acquisition. Then we go to the concept of common control transactions. Once all these three parameters are done, then we are sorted in terms of 103. Okay, so I think let's begin with the first input to you. And we start our thoughts in terms of acquisition accounting. So we need to begin our inputs in terms of acquisition accounting. Now, since you would have already gone through the regular sessions, you would have already remember that in terms of acquisition accounting, it is a 7-step model. So we have done a 7-step model in terms of acquisition accounting because the end part is to reach the acquisition accounting entry. So I'm just going to pen down those 7 steps quickly to you. So as a part of the acquisition accounting, we've got a 7-step model with which the acquisition accounting would apply. So the idea is to reach the acquisition entry in the books of the accounting acquirer. So we need to basically pass an entry in the books of accounting acquirer, and this entry is done on the date of acquisition. So we're looking at the entry in the books of the accounting acquirer on the date of acquisition. So first let's have a look at the entry and then we'll get into the nitty-gritties. So we look at the entry, assets gets a debit, liabilities gets a credit, and this is all at a fair value. You take the assets and liabilities and that's taken all at a fair value. Then we give a credit in terms of purchase consideration and in terms of NCI, because this would mean converting it indirectly into 100%. Because when you take the assets and liabilities in terms of control, you consider 100% of the assets and liability. Whether you get a stake which is 60, 80, 100, doesn't make a difference. Control means getting a control over all the assets and liability. So 100% of the net assets and 100% PC. And we get a balancing figure generally on the debit side. And that is supposed to be goodwill. Or it can be on the credit side, and that is supposed to be a capital reserve, which is also called a bargain purchase gain. So the ultimate objective in this particular case is to arrive at this acquisition entry. That's the basic objective. Because you are putting this entry in the books of the accounting acquirer, so you need to reach this particular entry, and therefore the 7 steps. And therefore, the 7 steps which follows, one is getting the date of acquisition, identifying the accounting acquirer, identifying the accounting acquirer, getting a list of net assets for the entry, getting a list of the net assets in this case. Number 4, calculating the purchase consideration. Number 5, calculating the NCI. Number 6, calculating the goodwill or the capital reserve. And number 7, putting this entry, which you can see on the right hand side. And each of these steps, if you recall, is connecting you to some data in the acquisition entry. I think just to connect the dots. So when you say the date of acquisition, you can see to decide when to put the entry. When you say accounting acquirer, in whose books it is to be done, then you're looking at the net assets. So we can say this is getting the net assets. You're looking at the purchase consideration. You're looking at the NCI. You're looking at the goodwill and capital reserve. So every element in this entry is got a connect with a 7-step model. So I would say if you get a larger question in terms of business combination, the best exercise is to go step by step. Identify the acquisition date, get the accounting acquirer, organize the list of the net assets, get the purchase consideration, get the NCI, get the goodwill or the bargain purchase gain, and then pen down everything in the form of the journal entry. So now what you're going to do, you know this quite well. I am going to go to each and every step one by one, make some quick mind maps, keep doing some questions with you. So we are going to go with each step, make some quick mind maps, but I think the questions which we're going to concentrate mainly is going to be on the purchase consideration, is going to be, I guess, this is the main area. I think because when you get individual questions based on this particular standard, I think most of the questions concentrate in terms of PC, especially in terms of the contingent considerations and maybe a bit on the deferred considerations and other things, share-based payments. So I think we're going to look at those particular inputs in this case. So let's go further. So that was my mind map number 3. So I think now I'll not call this as mind map 4, or maybe we can, but then, we'll get too many mind maps. So I think we're going to make a summary chart in terms of each and every steps. So mind maps for each step. Let's put it like this. So we've got now mind maps for each of the 7 steps. Mind maps for each of the 7 steps. I think let's put it like this. So we'll get 7 mind maps on each and every step, consolidating the picture. So let's, I think, begin with the first one. So I'm looking at, first of all, the step number 1, and that is about the date of acquisition. That is as far as the date of acquisition is concerned. Now, let's, I think, connect the dots in terms of the date of acquisition. So we need to remember that when you see the date of acquisition, it is the date when you acquire control. And when do you acquire control? Generally, the control is acquired when the purchase consideration is discharged. So getting the control coincides with the discharge of the purchase consideration. But then there is an exception, and that is you can achieve a control even before the consideration is discharged if there is supposed to be a binding agreement for the takeover and the parties have mutually agreed to pass on the control before the purchase consideration is discharged. So let's pen this down. So we can say the date of acquisition, generally, the date of acquisition generally is the date when acquirer gets control. When acquirer gets control. And what is the date when the acquirer gets a control? So we can say generally, that's again based on all general presumptions, generally when purchase consideration is discharged. When the purchase consideration is discharged. So the thumb rule which you need to keep in mind is the date of acquisition is when you get a control, and when you get a control, when the PC is discharged. But then as an exception, but you can say then as an exception, control can be acquired, control can be acquired before, control can be acquired before purchase consideration is discharged. Control can be acquired before the purchase consideration stands discharged. And how is that possible? And this is generally possible when there is a binding, when there is a binding agreement, when there is a binding agreement. And if you recall, in terms of the regular sections, some permutations, combinations, in terms of getting approvals, which are either substantive or mere formalities, can also change the things. There might be binding agreements, but it is subject to approval by authorities. And if the approval is something which is substantive, then the exceptions cannot trigger. But if you see a situation where the approval is something which is a mere formality, then yes, it can. So we can say the exceptions would be that there is a binding approval, and if subject to approval, and if it is subject to approval, then we can say the approval, then in this case, the approval is mere formality. The approval is supposed to be a mere formality in this particular case. Because if the approval becomes substantive in nature, then the exceptions in that case cannot trigger. So I think we're not doing any questions on the step number one. This was just to give you a quick recap in terms of the step one, that you need to consider the date of control coincides with the date of PC discharge. And the exception is, even without discharge of PC, you can get a control, provided there is a binding agreement between the parties and they mutually agree to pass on the control. But if the deal is subject to approval, it is something which is not substantive in nature. It's a mere formality in nature. I think that makes it step number one. Then let's make a mind map in terms of the step number two. So now we're going to make a mind map in terms of the step number two, that is on identifying accounting acquirer. So here I'm just going to make a quick summary chart in terms of step number two, just trying to recall and penning down the concepts in terms of that once you say that it is supposed to be an accounting acquirer, then what are the various permutations, combinations in which we evaluate all this? So in terms of the accounting acquirer, let's make an interesting summary chart. So we can make a chart like this, and we can subdivide this again into two parts. So these are the various permutation combinations. Just to get a quick deal in terms of identifying the accounting acquirer. It all depends upon the parameter number one. A new company is not created for the acquisition. A new company is created for the acquisition. And then it depends upon, in both the cases, the purchase consideration is mainly in the form of shares, or the purchase consideration is mainly in the form of, you can say, cash. So there is going to be two focus points when you're considering identifying the accounting acquirer. The first focus is in terms of new company created or not. The second focus in terms of whether the consideration is primarily in cash or primarily in shares. So therefore, the two columns. So let's say we say that new company not created. The combination one is a new company is not created. Or we can say new company is created. The new company is created. So when you say no new company is not created, we can say purchase consideration is primarily in cash, or the purchase consideration is primarily in shares. Here also we get the combinations. The purchase consideration is primarily in cash, or the purchase consideration is primarily in shares. So I think your focus points are all these four permutations, combinations, new company created or not, purchase consideration is primarily in cash or primarily in shares. Now just go back and connect the dots, what you've learned in the regular sessions as well. If a new company is not created, or even if a new company is created and the consideration is in cash, you don't create a new company, or you create a new company and the consideration is in cash, you're not giving anything to the shareholders of the company. You're not making them shareholders in your company. So in this particular case, the shareholders of the acquiree are given cash and that's it. So you don't make them the shareholders of your company, so your control can never get diluted. If the control can never get diluted, in this case, the legal and accounting acquirer is same. So in this case, you will notice the legal and the accounting acquirer will always be the same. In this case, the legal and the accounting acquirer will always be the same. This case as well, the legal as well as the accounting acquirer will always be the same. These two cases can never be a case of reverse acquisition technically. If your purchase consideration is primarily in terms of shares, that will never turn out to be a reverse acquisition. Next, if you say the purchase consideration is in shares, what do you need to do? You need to see pre-business combination and you need to see post-business combination and you need to compare the percentage. You need to compare the percentage here. Because as a shareholder of the acquirer company, they've got 100% control in that company. So when you give these shares to the acquiring company shareholders, they also become the shareholders of your company. Your stake will get diluted. So you need to see that dilution is to what extent. When you gave shares to the acquiring company shareholders, did they get the control over your company, or did you continue to get a control? So your control may get diluted, but you may still be in control. Your control may get diluted and you will lose a control. So in this particular case, when you compare the percentages, pre and post business combinations, you will come to know it can be either. It can be either a case of acquisition accounting. It can either be a case of acquisition accounting, or it can be a case of reverse acquisition accounting. So in this case, I would say it depends. I would say it all depends upon, what is the swap ratio or what is the exchange ratio, and accordingly this may change. Because once you say that you're giving shares to the acquiring shareholders, your percentage from 100 drops to, let's say, 70, but you're still in control. Acquisition accounting. Your percentage drops below 50%, you lost your control. Then the acquiree becomes the legal acquiree becomes the legal accounting acquirer. It's a reverse acquisition. And lastly, I think if we talk in terms of the fourth case, when you create a new company and the shares of the new company is given to the shareholders of the two existing companies, definitely it is a case of reverse acquisition. Definitely a case of reverse acquisition. Because undoubtedly one of the existing companies will definitely get a control in terms of the new company. So, moral of the story, if you look at the dots connected in terms of the step number two, let's put it like this. If your consideration is if the consideration is in cash, you create a new company or not, doesn't make a difference. It's acquisition accounting. If a new company is created and the consideration is in shares, undoubtedly reverse acquisition. So when you read a question and you say, okay, new company created, not created, consideration cash, acquisition accounting. New company created, consideration shares, reverse acquisition. I think the assessment is required only in one case when a new company is not created, the consideration is in shares, the comparison of the percentage pre and the post business combination will decide the fate. Otherwise, I think it's simple. Acquisition accounting, acquisition accounting, reverse acquisition accounting, and this depends, can be acquisition or can be reverse acquisition. So the only case to be assessed is when new company not created and the consideration is in shares, you need a pre and a post business combination comparative. So I think that is on the step number two. That's my mind map on the step number two. Now let's come to the interesting step, that is step number three. And in terms of the step number three, we're looking at now two sub-steps. Because when you're applying a larger question in terms of Ind AS 103, then you also need to consider the deferred tax implications, the concept of Ind AS 12. So it would be appropriate to divide the entire journey in terms of the step number three in terms of two sub-steps. So let's divide this step number three in terms of two sub-step. We can say sub-step number 3A. We'll look at the sub-step number 3A. Now, we need to connect that, when does the concept of a step number 3A triggers? It's only when a tax rate is given in the question that the concept of Ind AS 12 can trigger and the concept of step number 3A will trigger. So in this particular case, when you look at a step number 3A, so we can say if tax rate is given in the question, if the tax rate is given in the question, then I would say in this particular case, Ind AS 12 triggers. So then I would say Ind AS 12 triggers. So your thoughts need to be very clear in this particular case. When you see the business combination question and you look at the facts that yes, I am given a tax rate in the question, you need to remember your step number three in terms of two parts, Ind AS 12, then the list of net assets. Now, in this particular case, let's remind you the inputs in terms of the Ind AS 12, a quick mind map on this. So we can say, let's make it like this, assets and liabilities, to make it very, very clear. So what you want to focus in terms of this aspect is, look at all those assets and liability where the assets and liabilities are taken at a fair value. As a part of the business combination, look at all those assets and liability whose fair value they are taken at a fair value. So in this case, what you need to do, you need to consider the assets and liability which are taken at fair value. So you need to focus on the assets and liability which are taken at a fair value. Now look at the permutations and combination. So if you look at an asset or if you look at a liability, so in this case, the carrying amount, which is supposed to be putting in the brackets fair value, is greater than the tax base. Because in this case, the carrying amount is nothing, but it is equal to the fair value, and that is greater than the tax base. In terms of liability, the carrying amount, that is the fair value, is supposed to be lesser than the tax base. In these two cases, it is supposed to be a taxable temporary difference. And the taxable temporary differences will lead to a deferred tax liability. So you need to make a list of all those assets and liability whose book value, that is the fair value, is different as compared to the tax base. So if you get the difference, it is taxable temporary difference resulting in a DTL, part of the acquisition accounting entry. And similarly, if you look at the assets and liability, in this case, and the carrying amount, which is the fair value, is less than the tax base. For liabilities, the carrying amount is greater than the tax base. So it's a opposite combinations in this case. I would say this leads to deductible temporary differences. This leads to a deductible temporary differences, which will result in a DTA. So this is what you need to apply. This is nothing but a quick summary chart in terms of Ind AS 12. Looking at the comparisons and getting a deferred tax asset liability, which is a part of the acquisition entry itself. So I think let's put a note across out here. So DTL and DTA will be a part of net assets. So they will be a part of the net assets in the acquisition entry. So when you will put the acquisition entry, so these deferred tax assets liability will all be a part of the acquisition entry, and that would ultimately change the figure of goodwill. And I think here you should also connect a few dots. What do you remember in terms of Ind AS 12? In a business combination, if a goodwill arises and if that goodwill leads to a DTL, it is not captured. But if the goodwill leads to a DTA, it is captured. So that's an implication of Ind AS 12 with reference to Ind AS 103. So I think I'll just like to pen that down as well. So let's put it like this. So I think there's another important inputs to be remembered, that if goodwill results in DTL, it is not created, but the goodwill results in DTA, it is created. So that's another aspect. So this is like the assets and liabilities other than goodwill. Assets and liabilities other than goodwill. So when looking at assets and liabilities other than goodwill, then this chart applies. But if there is a goodwill and that goodwill arising in a business combination results in a DTL, Ind AS 12 prohibits you because of that circular effect. And if it results in a DTA, then in that particular case, it is recognized in the acquisition entry. Okay, so this was on the step number 3A. Now let's go further. So we are looking in terms of the substep number 3B. Now we're looking in terms of the substep number 3B, and I think that's a crucial step. But I think we need to just keep a very simple mind map. I am just going to give you a quick mind map on this, that when you create a list of the net assets, so what are the considerations which you need to keep in mind? Because here you've got a couple of exceptions which needs to be considered. Because in this case, we need to see that, okay, this is to be taken and this is not to be taken. So there is a wonderful chart which is given in the study material as well. We've already dealt with that in detail in the class. But here, I'm just going to give you a quick overview in terms of the concepts. So the first thing what you need to keep in mind is a complete simple thought process. So let's say this is the balance sheet of ICAI. And let's say this is the acquisition entry. This is the acquisition entry in the books of acquirer. So I'm looking in terms of balance sheet of the acquiree and the acquisition entry in the books of the acquirer. Now, let's, I think, first of all, take a quick recap in terms of the basic thought process, which needs to be very clear. The thumb rule is all the assets and liability in the acquiree's balance sheet would be in the acquisition entry at a fair value. That's the basic thumb rule, which you need to remember, that all the assets and liability in the acquiree's balance sheet is a part of the acquisition entry at a fair value. So, the thumb rule. So, what you need to consider as a thumb rule, that we can say that all the assets and liabilities will appear in acquisition entry, will appear in the acquisition entry at a fair value. That's a basic thumb rule, that what is appearing here would also appear here at a fair value. But then there were a total of 3 exceptions. But here we remember that there are a total of 3 exceptions in this case. Now, what are the exceptions? So we've got a basic of 3 exceptions which stems out. Now, the asset and liability is here, and it also appears here, but not at fair value. The assets and liabilities are in the balance sheet of the acquiree, and they appear in the acquisition entry, but not at a fair value. I think one of the best exceptions is NCA, held for sale, which is in the books at fair value less cost to sell, and it is going to be captured in terms of fair value less cost to sell. So I think the best example out here is going to be a non-current assets held for sale. And I think we'll just make a quick mention that this non-current assets held for sale is captured at fair value less the cost to sell. So that is one exception you need to see. The second, the asset liability is not appearing here, but it still appears at a fair value. The asset liability is not here, but it still appears out here at a fair value. And I think the most important one is the contingent liability and the corresponding indemnification assets. And I would say even the internally generated intangibles, because the internally generated intangibles cannot be in the balance sheet of the acquiree, but they are purchased for the acquirer, so they would appear. So I would put it like this. The examples out here would be contingent liability. It can be indemnification assets. It can be indemnification assets. And here you also need to remember very clear that when you say indemnification assets, the indemnification assets cannot exceed more than the value of the contingent liability. If you capture the contingent liability at 10 lakhs, the indemnification assets cannot exceed 10 lakhs, even if you are able to recover more than 10 lakhs. And I think at this stage, let me also just add another inputs. So in terms of the items, I would just add another input. So we can say there will be certain intangible assets as well. So there will be certain intangibles. What is internally generated? What is internally generated is purchased. What is internally generated is purchased for acquirer. What is internally generated is purchased for the acquirer. So as a part of the list of the net assets, you'll also add those intangible assets also in this particular list. Then next, what we remember. So the assets and liabilities are not appearing here, but they will appear at other than fair value. They will appear at other than fair value. And I think one of the good examples is the deferred tax liability and the deferred tax asset, which you've already captured in terms of the step number 3A. I think that's the best example. So what I've taken out here is not every asset and liability is an exception. What I've taken out here is the most common, exceptions which we generally confront in the questions. Contingent liability, indemnification assets, deferred tax asset liability. So there are other examples also, like for example, if you remember leases and other things, but share-based payments is taken separately. Pre-existing relationships are taken separately, reacquired rights are taken separately. So I did not, take that all that stuff out here. So in this particular case, could you remember the entire list of exceptions? But I've taken the most common kind of things. So I think if you just try to connect the dots once again, so we can say the thumb rule. The thumb rule which comes out of the application of this particular step is assets liability in the books of equity will definitely appear in the acquisition entry at a fair value. That's the basic input. The exception is, can the asset liability in the books of equity appear in the books of acquirer as it is NC held for sale? Something which is not in the balance sheet of equity still appears at a fair value or other than fair value, at a fair value, indemnification assets, contingent liability, intangible assets. And if you look at something other than fair value, I think what you computed as a DTA in terms of step number 3A, that gets inserted. Okay, that's great, wonderful indeed. So I think this was on my step number 3. This was on my step number 3. I don't think so. I have put any, basic questions on this step in my super summary questions. So I think we're going to go ahead to the crucial step number 4 now. Because as I said, the main questions, what we're going to concentrate on in terms of the initial part, because we'll do larger questions at the end. But I still want to take the opportunity of creating some good mind maps for each and every step so that it remains absolutely clear in the minds. So let's go to the next agenda, and that is step number 4. I would say this is one of the most crucial and the lovely steps which is there in terms of India's. So we're going to make a very good connected chart on this particular concept of a purchase consideration. So we're looking at the PC, that is the purchase consideration. So this is PC, that is purchase consideration. Now, if you remember the thoughts, in terms of what we've covered in the regular sessions, I made a list of 7 issues pertaining to the calculation of the purchase consideration. Because when you're looking at the concept of a purchase consideration, I think as a matter of a comprehensive list of various issues which can arise. So we decided a list of 7 issues. So let's just try to recall those 7 issues. Then we'll enter into those 7 issues one by one and make some quick mind maps on that. So I gave you for easy remembrance that one of the issues which you need to consider is called DC. That's called a deferred consideration. The second agenda is what is called CC. And there are 2 CC. One is a contingent consideration, that is employee capacity, and one is a contingent consideration, that is a shareholder's capacity. So if you've got a contingent consideration in the capacity of the employee, not a part of PC, but if there's a contingent consideration in the capacity of the shareholders, definitely part of the purchase consideration. So you've got a DC, you've got a CCE, you've got a CCS. Then the concept is TC, that is a transaction cost which is not included in the purchase consideration. I think we were talking of that a bit earlier, that TC has got a different accounting in an asset acquisition and in a business combination. The next, number 5, that is the PHI, that is the previously held interest. Where as a part of the acquisition, previously you acquired some stake, so we need to update that PHI at a fair value. Number 6, we've got SBP, that is called a share-based payments. And in terms of share-based payments, there could be a replacement of share-based payment awards by the acquirer to the acquiree's employee. He says, I will replace your original awards and give you my new replaced awards. And then the concept of the seventh issue, which is called a pre-existing relationship. The pre-existing relationship would also lead to another very interesting point, and that is a case of reacquired rights. It all depends upon whether the nature of the relationship is contractual or it is non-contractual in nature. So I think first let's make a list of those seven issues, and then we'll see, what is to be done on a very apparent level on each of these issues. But I think we need to definitely go a little more deeper in terms of contingent consideration, in terms of a share-based payments, and in terms of a pre-existing relationship. So I think within this, we're definitely going to do a little more extensive practice. So I think let's first make a list of seven issues. So review wants to calculate a purchase consideration at a larger level on any question, something which should definitely click to the mind. So let's make a list of the seven issues to begin with. 4, 5, 6, and 7. So the first one is what we call a DC, that is supposed to be a deferred consideration. That is supposed to be a deferred consideration. Now, on a very apparent level, if we just try to take a recap, the deferred consideration is definitely a part of purchase consideration, and that is taken at a fair value. And in this case, the fair value is supposed to be the present value. So whatever is the present value of the future payment, because when you say a deferred consideration, we are saying that this is an amount which is payable in the future, and we need to consider a fair value of that amount, which is nothing but the present value. We'll make a very interesting chart after the discussions, because you need to connect this particular step typically with the step number 7, because the purchase consideration will also impact the entries in step 7. And if you recall, in terms of step 7, we did something very interesting. Entries pre-business combination, entries on the date of acquisition, entries post-business combination. So I think this PC elements has got something very good connect in terms of step number 7. So let's come back. So one is DC, then there is CC. This is called contingent consideration. This is called contingent consideration, and even this is CC, that is contingent consideration. Now, the only difference between the two contingent considerations we have taken out here is one is a contingent consideration in the shareholder's capacity, and one is the contingent consideration which is paid in the employee capacity. So when it is in the shareholder's capacity, it's a part of PC, and that's taken at fair value. And if it is in the employee capacity, it's not a part of PC. It's not a part of the purchase consideration. So I think in this case, what you need to connect out here is when you're looking at a contingent consideration, the thought process in terms of contingent consideration is you're looking at a situation where the acquiree shareholder is also the employee of the company. I think let's put the correct concept out here. Especially when you're looking at the concept of a contingent consideration, the thought process is clear that you're looking at a consideration which is given to the employee shareholder of the acquiree. The shareholder of the acquiring company is also the employee of the acquiring company. So you need to very carefully look at the facts and decide, is the payment which is being given to him, it is in the capacity of the employee, then it's not PC. Then share-based payments would trigger in this 102, if the payment is in shares, of course. And if it is a case of a capacity of the shareholders, then it's a part of PC at a fair value. The next element is the TC, and that is called a transaction cost. That is called a transaction cost. And as far as the TC is concerned, it's not a part of PC. It's not a part of the purchase consideration. This is expensed in the paper. The next element which is there is called PHI, and that is what is called previously. That is called previously held interest. That is called previously held interest. That is PHI. So as a part of the acquisition, you might have acquired some stake in the acquiring company at an earlier stage. So it's time to update that. Here we are also going to do some questions because PHI is one of, again, a very interesting agenda where you get questions independently in the exams. So we'll make some good mind maps on that. But as of now, let me just give you that it is a part of PC at a fair value. And then comes the other input, and that is called SBP, that is share-based payments. That is SBP, that is share-based payments. In terms of the share-based payments, you are trying to basically replace the awards. Whatever awards that is share-based payments are given by the acquiree to its employee. So you are looking at that, let's as an acquirer replace those awards. So I would say here again, we consider fair value, but this time it is a proportionate fair value. So we'll talk of this very soon, but it is definitely a part of PC. It is definitely a part of PC, but in this case, we take proportionate fair value. It's a pro rata fair value, so we consider a proportionate fair value, which we'll talk of. So this is the 6 agendas. Now the next one. So this is DC, CCS. Let's put it as CCS and CCE. Then there is TC. Then there is PHI, share-based payment. And finally, there is a pre-existing relationship. There is a pre-existing relationship. So prior to entering into the acquisition deal, there might have been some relationship between the acquirer, acquiree, which all depends upon whether it is contractual or non-contractual in nature. So we'll talk of this. So this can be either contractual or it can be non-contractual in nature, and depending, it is adjusted in the PC. I think least we forget the one of the agendas to be put across is when you consider the purchase consideration, we typically consider the cash and we typically consider the shares issued at a fair value. So this is the bare minimum which enters the calculations of the purchase consideration. So your mind should be tuned at this stage that, okay, when you calculate a purchase consideration, so we've got shares and the cash, the shares issued at a fair value, then 7 issues should flash your minds. DC, fair value, CCS, fair value, CCE, no, TC, no, PHI, updated at fair value, yes. Then there is SVP, yes, which is pro rata fair value. And then there is a pre-existing relationship. I did not make a mention, but that would be also adjusted in the purchase consideration. How? That we'll see later. But now, what is the focus points? As a part of the larger picture, I think what we need to understand is for smaller kind of questions. So what I'll do, I'll cover this as one chart. We're not going to talk of TC, but we'll definitely talk of the PHI as another chart, share-based payments, and the pre-existing relationship. Which means as a part of the main exams, you could get some good questions on this area 1, PHI 2, share-based payment 3, and the pre-existing relationship. So as a part of the questions exercise, I put some extensive questions on this area itself. So let's do first one thing. Let's discuss this block as a whole. And then I think we'll discuss the concepts of the PHI, SBP, and all of the things. Let's make a mind map on this. Within this, a mind map. So this is a mind map within the mind map. So the step number 4, we're making sub mind maps. Sub mind maps. So this is the mind map, which is, we can say, on the subparts of the step number 4. So making some mind maps on the subparts of step number 4. So I want to take, first of all, in the block DC, CCS, and CCE. Now, in this particular case, I think let's first of all understand quickly the parameters which we need to keep in mind in terms of deciding that it is DC, it is CCE, and CCS. Now, so here also, if you remember, we made a 3-step model. Here again, we made a 3-step model in terms of remembering things. So we decided that if you're looking at a DC, a CC, S, or a E, what do you need to do in first instance? Is the payment to be paid in future? The focus, first of all, is to decide that is the payment going to be paid in the future, because one of the common elements in DC and CC is the payment which is going to be done at a future date. So in this particular case, if you get the answer yes, then I'll go to the step number 2. But if you say the answer no, then in this case, it's neither a deferred consideration nor it's a contingent consideration, because unless the payment is made at a future date, it's neither DC, it's neither CC. So one of the parameters to see is that it is paid in the future. The second step, what we need to consider is the payment which is made in the future. Is it based on ifs and buts? Is it based on any conditions attached in the future? So, are any conditions attached? We're looking at are any conditions attached. So when you say are any conditions attached, the answer is a yes or no. So if you say that there are no conditions attached, it is deferred consideration for sure. And if you say there are conditions attached because the conditions may or may not be met, it is contingent consideration for sure. So if you say no, it is a deferred consideration, and I will take the fair value as a part of PC. And when you say that we are taking a fair value, the fair value is nothing but the present value of the future payment. It is the present value of the future payment. And I think what the dot you need to connect is, when you consider the deferred consideration, the dot which you need to connect at this particular stage is, once you take the present value today, there will be an unwinding in the future as well. Because whenever, in terms of Indias, you consider a discounting that is present value, in the future what takes place is unwinding of discount, that is compounding. So you need to remember that this concept would lead to unwinding, that is a finance charge. Okay, and if we say that it is supposed to be a yes, it is definitely a contingent consideration, and we would like to go to the step number 3. Once you say that yes, it is a contingent consideration, then we go to the step number 3 in this case. Then finally, once we come to the step number 3, now what do we need to see? Since you've decided that it is a contingent consideration, you need to decide the capacity in which it is paid. Is it paid in the capacity of a shareholder or an employee? That depends upon the types of conditions. That depends upon the types of conditions. If you attach a service condition to these parameters, it is in the capacity of employee. But if the conditions attached are other than the service condition, then it is shareholder's capacity. So we can say what is the nature of conditions. So we need to see what is the nature of the conditions. So we can say the nature of the conditions could be either you attach service conditions or they are not service conditions. Either we attach the service conditions or they are not service conditions. If you say that they are service conditions, that means you want the employee to serve you for a certain tenure, then it is CCE, and that's not a part of PC. Then it is not a part of the purchase consideration. But if you say it's not related to service, then it is CCS, then it is a part of purchase consideration at a fair value, which will, of course, be given in the question. So I think we just connect a few dots at this particular stage. I think we can just, just have a little quick inputs on this. So we can say in this particular case, if it is a case of DC, no conditions paid in the future, fair value, present value. If it is a payment in the future dependent upon service conditions, CCE, not a part of PC. And if there is a payment in the future dependent upon conditions which are not service but any other parameter, it is CCS, and that is a part of the PC at a fair value. But here there is another very interesting connect where the questions comes in, especially when it comes to the contingent consideration, that the payment is in cash, the payment is in shares, and is it a financial liability or is it an equity instrument? And what is the concept which is connected in terms of Index 32? Wow. But I think let's discuss that after the break, and then let's do some questions on this area as well. We made a couple of mind maps this morning, so we'll do some more mind mapping and then we'll start doing some questions on this area as well. We need a good level practice in terms of the step number 4. So today my focus is to give you an extensive practice on the area in terms of the step number 4, because step number 5 and 6, NCI goodwill is not a big deal unless we start locating, joining the dots in terms of impairments on other things. That comes later. So I think let's first take a 10-12 minutes break, I guess. Then I think we'll start back the journey back. Thank you. Hope you had a relaxation of mind, a lot of information. I think let's take the input further. So, to remind you, we were discussing the concept of a purchase consideration involving the agenda of 7 issues, where I gave you a three-step input in terms of DC, CCE, as well as CCS. But there is more before I go to the question, and I discuss the concept of a contingent consideration a little more detail. Rather, let's, I think, consider all the 3 elements in another wonderful mind map on this particular area. So I'm just going to first make some thoughts. So let me just make another mind map on this area. So I want to make a little summary chart before I take you to a question on this area that is on the DC as well as CCE and a CCS. Now, what's at the back of the mind is connecting the step number 4 and the step number 7. Because when you're looking at a deferred consideration, we need to see the role of that in step 4 PC. We need to consider that when you go to step number 7, that is for journal entry. So what will be the impact, if any, on a pre-business combination entry or on the date of acquisition, or you can say post-business combination. So I'm going to make a very interesting chart which will help us to summarize the entire inputs. So let's take a column first of all on a particulars. And I want to consider the insights in terms of step 4. And step number 7, I want to divide this in 3 parts. That's going to give us some good, wonderful permutations, combinations on this. So at the first instance, I'm looking at the impact on step 4. Then I'm looking at the impact on step number 7. Here I'm looking at a pre-business combination on the date of acquisition and post-business combination. So we're looking at these 3 aspects, because earlier when I gave you the insights in terms of the step number 7, it was typically on the date of acquisition. Now I want to see the insights pre, post, and on the date of acquisition. And we want to see this blend in terms of 3 areas: DC, CCE, as well as a CCS. That will give us a good combination in terms of things. Now, if I consider deferred consideration, contingent consideration, shareholders' capacity, and in the employee's capacity. Step number 4 impact, you've already seen that when it comes to a deferred consideration, you take a fair value as a part of the PC, which is the present value. So this is definitely a part of purchase consideration. And this is at a fair value, which is nothing but as good as a present value. Any impact on a pre-business combination? No. Any impact on the date of acquisition? Just it's part of PC. But any impact on a post-business combination? Yes. Unwinding of discount. Because since you've taken the present value of the future payment, so you need to apply what we commonly call as unwinding of discount. So you are going to put the entry in the subsequent year, finance charge gets a debit, and the deferred consideration gets a credit. This can also be tested as an independent question as well. So it's not necessarily that as a part of the larger question, the examiner tests your inputs on the DC, but it can be tested as a separate question as well. So we need to know that in a post-business combination, the unwinding of discount would trigger. Next, if I look at a contingent consideration in the shareholder's capacity, it's a part of the purchase consideration. And this is at a fair value, not a present value, but this will be simply a fair value, which is given in the question. Any impact on the pre-business combination? No. And is it a part of the purchase consideration? Yes. Now, in this particular case, what do we do? Post-business combination. Now, that's interesting. If you say there is a contingent consideration, you need to consider the mode of payment, because the mode of payment could be cash or the mode of payment could be equity shares. If the mode of payment is cash, then this obligation will become a financial liability as per Ind AS 32. And if the mode of payment is shares, then it depends upon whether it passes or fails a fixed test. If it passes a fixed test, that means it's an equity instrument. And if it fails a fixed test, then becomes a financial liability. And this contingent consideration, as per Ind AS 109, if it is a financial liability, is measured at FPTPL, which means the fair value changes are going to be captured as a part of the future accounting. That's, I think, the brilliant point we need to keep in mind. So on a post-business combination, it depends upon the mode of payment. It depends upon the mode of payment. So if you say the mode of payment is supposed to be cash, then it's a financial liability and it is measured at fair value through P&L, with the fair value changes being taken in the profit and loss of the company. And if the mode of payment is in terms of shares, it depends whether you're going to issue fixed shares or you're going to issue a variable shares. And accordingly, if it is fixed shares, it becomes an equity instrument. No remeasurements are required. If it is an equity instrument, no remeasurements are required. But if it is variable number of shares, then it becomes a financial liability, which is again measured at FPTPL. I think that's a very important input. You must be definitely remembering the connecting dots between the step 4 and the step number 7. Then what is the impact on the PC? That's step 4. And also the step 4 is nothing but it is connecting the date of acquisition. But what is important is to see any impact on a pre-business combination or any impact on a post-business combination. That is important element for independent question. Then further, when you take the contingent consideration as a part of the employee, it's not about a PC. It's not a part of the purchase consideration. So therefore, pre-business combination, nothing. And date of acquisition, also nothing. But is there any impact on a post-business combination? Yes. If this is in the mode of payment, which is shares, then Ind AS 102 would trigger, because generally this payment would be in shares. So considering that this payment would be in terms of shares, then you need to apply Ind AS 102. It's a share-based payment. And if it is a share-based payment, then Ind AS 102 would trigger. And accordingly, if it is an equity settled transactions, or the cash settled transactions, the entire accounting of booking an employee compensation expense would trigger. Okay, so I think I've connected a wonderful summary chart in terms of the 3 agendas. I have indirectly covered 4 agendas of PC, DC, CCS, CCE, as well as TC, because there's nothing much to explain in terms of PC. It's not a part of PC. Rhythmic words indeed. I think now with this insights, we're ready to do another question with you. I'm now going to share on the screen. There is a wonderful question, that is question number 2. And this question number 2, though it very clearly says it's in the capacity of the shareholder, this question came in RTP. It's also there in the education material, which is issued by the institute. Though it is issued by the Accounting Standard Board, but I think I just wanted, to pick this wonderful question. It's, I think, in the study material as well. It's there in the RTPs as well. So let's read the facts. It says, how should a contingent consideration payable in relation to a business combination be accounted on initial recognition and a subsequent measurement in the following cases? It says in point number A, on 1st April 2016, A acquires 100% interest in B. As per the terms of the agreement, the purchase consideration is payable in the following 2 tranches. There is an immediate issuance. Immediate issuance cannot be a case of DC or a CC. So there is an immediate issuance of 10 lakh shares with a face value 10. Then he says a further issuance of 2 lakh shares after 1 year if the profits before interest and tax for the first year exceeds 1 crore. Now you can see very clearly when it says a further issuance, it is a payment after 1 year, futuristic. It is dependent upon conditions, but these conditions are not service. They are achieving a target in terms of target profit. So it is definitely a CCS. The fair value of the shares on the date of acquisition is 20. And further, the management estimated that on the date of acquisition, the fair value of the contingent consideration is 25 lakhs. Then he says during the year ended 2017, now it's coming to the end of the year, subsequent measurement. It says the PBIT exceeded 1 crores and on 31st March, the fair value of the shares has become 25 rupees per share. Then further, I'm also given in the part number B now, it says continuing with the fact pattern in A, except for the number of shares to be issued after 1 year is not fixed. And then it says, rather, it says A agreed to issue variable number of shares having a fair value of 40 lakhs after 1 year if the PBIT for the first year exceeds 1 crore. Now you can see in the part number A, the further issuance is of 2 lakh shares, which is a fixed number. The mode of payment is shares, it's a fixed number. And then it says in part number B now, assume that the number of shares to be issued is not fixed in number, but it is supposed to be variable in number. So I think let's organize the data. So I'll just keep the question in front of me as well. So this is there in the study material also. So let's, I think, organize the information. So this is my question number 2. I'll just create the permutations, combinations, and answer them in a chart format. So we are looking at the answers to 2 different parts, A and B, and we're looking at the inputs, what happens on the initial recognition, and what happens on the subsequent measurement as well. So I'm looking at 2 parts of the question, the part number A as well as the part number B. Okay, so let's, I think, begin with the inputs. If I look at the data which is given in the question to begin with for part number A, it says that there is an immediate issuance of shares. So when you look at immediate issuance of shares, we are issuing a total of 10 lakh shares. And we need to consider the fair value of the shares. He gives you the fair value a little below. It says the fair value of the shares on the date of acquisition is 20 rupees per share. This is not a deferred, this is not a contingent consideration. It's immediately issued. We're taking the fair value of the shares issued. Then he says a further issuance of 2 lakh shares. When it says a further issuance of 2 lakh shares, so this is supposed to be a contingent consideration. It is in the shareholder's capacity. And what is important is that the mode of payment, putting it as MOP, it is supposed to be fixed shares. If it is supposed to be fixed number, then it is supposed to be equity instrument as per Index 32. It is supposed to be an equity instrument as per Index 32 in this particular case. So we will consider the fair value of the shares. This is also fair value, and this will also be fair value. It says the management estimated that the fair value of the contingent consideration. So we're already given the fair value of this contingent consideration. It is 25 lakhs as a total. So if you take this total, it is 200 plus 25, it comes to 225 lakhs, that is PC. Now, in this particular case, when we come to the subsequent measurement, since it is an equity instrument as per Index 32, no remeasurements is to be done. In this particular case, we can say no remeasurement is required. Because as per Index 32, it is an equity instrument, so remeasurements is not required in this particular case. Great. Now let's go further. As far as the part number B is concerned, he tells you that now the number of shares are not fixed, but initial measurement would remain the same. So this would, of course, remain the same. But the only difference now is that in this case, it is a contingent consideration in the shareholder's capacity. And in this case, the mode of payment is supposed to be variable number of shares. It is a variable number of shares. And if it is a variable number of shares, it becomes a case of financial liability as per Index 32. It becomes a case of financial liability as per Index 32. So remeasurement required. So in this particular case, we need a remeasurement. So in this case, a remeasurement is required. And since we need a remeasurement, let's see what is the fair value. It says in the question that the fair value is now equal to 40 lakhs. So we can say from 25 lakhs, the fair value changes to 40 lakhs. This is an increase in the liability. If this is an increase in the liability, then in this particular case, this increase in liability is going to be measured at FPTPL. It's a loss for the company. So we're going to put the entry profit and loss gets a debit. And you can say the financial liability gets a credit. And this is 15 lakhs loss arising on account of remeasurement. I think that connects the dots equally well. So as a part of the purchase considerations, I think we're done with the 4 agendas out of the 7 issues. DC, now we know, is a part of PC with an unwinding in the future. CCS is a gain at a fair value, and the subsequent accounting depends upon the mode of payment. If it is cash, it is financial liability, FPTPL. If it is shares, variable in number, FPTPL. If it is shares, fixed in number, equity instruments with no remeasurements happening. PC, not a part of PC. Now let's come back on the agenda. So I think out of the 7 issues done, now we are on this interesting agenda, PHI. That's a lovely discussion. We need to make another mind map on this PHI because we've got a question waiting for you on this area. Because this is another area, which is being tested in the exams as well. I remember June 2019, there was an examination question that came for 8 marks in the exams on this PHI. So let's make another mind map on. So this is another mind map, which is on the sub-step of step 4. Which is on the sub-step of step number 4. The focus is on PHI. The focus is on PHI, that is called previously held interest. That is called previously held interest. So it is called previously held interest. Okay, now let's connect a few dots. Now, when you look at the concept of PHI, your mind should immediately go back and decide that typically there will be 2 cases in terms of PHI. Converting from a passive investor to a case of control. And the second is converting from a significant influence to the concept of control. Because when you're looking at a PHI, which means you already have some stake and you're acquiring a further stake, resulting in a conversion of control. So there will be 2 cases. You can call this as a step acquisition as well. So we want to connect the dots that once it is a case of moving from a passive investment to a case of control, what is to be done with reference to the step number 4 and with reference to the step number 7. In terms of step number 7, again, as a part of as a part of date of acquisition and a post-business combination, I would make a similar kind of summary chart, which we did in terms of the 3 issues on the PC. Let's, I think, do this. So let's make a good summary chart on this area, correlating the dots in terms of step 4 and the step 7. So just to make a mention that PHI also refers to the case of, you can say, step acquisitions. So I think let's make a super summary chart here as well, and then we'll see a question on this area as well. So let me make a summary chart in this case, looking at the impact in terms of the step number 4 and in terms of the step number 7, looking at the impact in terms of all the three aspects. So this is step number 4, this is the step number 7, this is pre-business combination, this is date of acquisition, and this is post-business combination. So there are two cases what we are working on. So let's take this as case. So we're looking at the first case, passive to control. It's a movement of passive to control. And the second one is a case of significant influence to case of control. So these are the two permutations and combinations what we want to look into. So that will summarize our chart in terms of the PHI. Now, you need to connect the dots when it is a case of a passive to a case of control. You're moving from Index 109 to the case of Ind AS 110, or you can say 103 as of now. So in this particular case, what do you need to do? It's a movement. It's a movement in terms of Ind AS 109 to 110. And this is a movement in terms of Index 28 to Index 110. Now, you need to go back and recall that when it is a case of 109, equity investments are measured at either FVTPL or measured at FVTOCI, because these are investments which will undoubtedly not held for trading. So the management would have taken a call whether these investments are supposed to be held for trading or not. So they get a choice because it is not held for trading. So FPTPL and FPTOCI. So depending whether you choose an FPTPL or depending whether you choose an FPTOCI, if you've taken FPTPL, then you can say, in this case, first of all, in step 4, you will take this at fair value and you will take this at fair value. So in any case, for the purpose of the purchase consideration in step 4, it's a part of PC. It's a part of the purchase consideration at a fair value. So whether it is taken at FPTPL, whether it is taken at FPTOCI, you will undoubtedly take it as a part of the purchase consideration at a fair value, undoubtedly. Then, when it comes to the pre-business combination, so what you will do, you will take the difference between the book value versus the fair value, and this difference will be taken in the profit and loss. This entry will be done in a pre-business combination period, not in the date of acquisition. You need to revalue, uplift the initial investment, the PHI at a fair value. So book value, fair value differences will be taken in the P&L. In this particular case, the book value and the fair value differences will be taken in other comprehensive income. So if it is categorized as FPTPL, the gain loss in the P&L, and if it is categorized as FPT-OCI, the gain loss in the OCI. And I think worth making a mention that in this case, there will be an accumulated balance standing in the statement of changes in equity. The accumulated balance of the OCI will be standing in the statement of changes in equity that needs to be transferred to RE. So in this particular case, we can say accumulated balance of OCI in SOKI will be transferred to retained earnings in this case. So in this particular case, whatever is the accumulated balances, which is there in the tab number 3 of statement of changes in equity, will be transferred to the retained earnings at this stage. And there's nothing in terms of data acquisition, but I can only say that it's a part of PC. Nothing to be done in terms of post-business combination, because now the concept of control is arisen. Now let's go to the next situation. Now, in terms of the next situation where there is a conversion, significant influence to a case of control, switch over from Index 28, that is equity method. Now, when it is a case of switch over from an equity method to a case of control, again, fair value upliftment. So in this case, we will take it as a part of PC at fair value. And in a pre-business combination, whatever is the difference between the book value, which is based on equity method, compared to the fair value, this is going to be taken in the profit and loss. And now comes the most interesting issue. The most interesting issue where you can, definitely get a question. We'll practice that question as well. Now, in this particular case, when you say that the difference in the book value and the fair value is taken in the P&L, now what you need to take care out here is during the application. Now, watch this carefully. You just need to recollect what you've learned. As a part of the equity method of accounting, under Index 28, you would have accumulated the balances in OCI. Because when you applied an equity method, the investment was debited. Sometimes the P&L was credited. Sometimes the OCI was credited. So during the course of application of Index 28, that is equity method of accounting, you would have debited investments, sometimes given a credit to P&L, sometimes given a credit to OCI. So there will be an accumulated OCI balance that needs to be scrutinized, whether it is a case of R or is it a case of NR. So in this particular case, you need to make a scrutiny. You need to make a scrutiny of, you can say, accumulated balance in OCI. You need to make a scrutiny of the accumulated balances of OCI and see whether it is NR or it is R. If it is a case of NR, this money will be transferred to RE, and if it is R, then this money will be transferred to the PL. So the task becomes a little more technical when it is a step acquisition moving from Index 28 to Index 110. There are basically two things which needs to be taken care in terms of pre-business combination. One is the comparison of the book value as per the equity method versus fair value, and that gain or loss is taken in the P&L. And the second most important task is, due to the application of equity method, the accumulated balance in SOKI, the accumulated balance of OCI in SOKI, that has to be scrutinized between no reclassification and a reclassification. The money which is in the no reclassification will be taken in the retained earnings directly. But the money which is in the reclassification category is going to be transferred in the profit and loss. So as a part of the data acquisition, it's a part of PC. And if you look at the post-acquisition, nothing is to be done in this case. So I think that makes a good summary chart in terms of the PHI, that is the fifth agenda in terms of our purchase consideration. I think definitely, we must do a question at this stage on this area. So let me share a question to you on this particular case as well, though I think I put that question a little later maybe. But I think let's do that question at this stage itself. I pushed that question a little later in terms of maybe Index 110 practice. Let me just look at that. In that Super 20 questions, I guess we've taken that question as well. Yes, that is question number 10 actually. It's on loss of control actually. Okay. So this is actually on a loss of control, not exactly a question which deals with this issue. No, I think there is a question. No, we have. We just did the question number three. Yes, we have. The question number three, let me share you on the screen, June 2000 question. Right. Let's have a look at this particular quiz. Question number three, this is an examination question. June 2019, it came for 8 marks in the exam. So let me just read the question to you. Question number three, similar question is there in the study material also, but this is an examination question. It says Deepak, an automobile group company, acquires a 25% voting shares of Sean, another automobile business, by paying 4320 crores on 1st April 2017. Deepak accounts for the investment in Sean using equity method as per Indus 28. Then he says on March 2018, which is at the end of the year, Deepak recognizes the share in the net assets using equity accounting. He is filtering you and telling you that as a part of the Indus 28 equity method application, what entries have been done. So you can see that he captured the share of profit and loss. So the entry which was done must have been investment debit and profit and loss credit. Then there is a share of exchange difference in OCI. The entry which would have been done would have been investment debit and OCI credit. And then there is a share of revaluation reserve. The entry which would have been done is investment debit and OCI credit. So during the course of equity method of application, investment got a debit, P&L got a credit of 378, OCI got a credit of 54 and 27. So there is an accumulated OCI balance in terms of the tab number 3 in SOKI. Now, as far as the exchange difference is concerned, that arises on account of Indus 21. And that exchange difference which is taken in OCI is because of translation of the financial statements, which is taken in FCTR. There is foreign currency translation reserve, and that is supposed to be our reclassification in nature. And the amount which is taken in the revaluation surplus is by virtue of Indus 16, and that is supposed to be, you can say, NR in nature. Then he says the carrying amount of the investment is given. So to the acquisition cost 4320, he's added all these three amounts. Then he says on 1st April 18, Deepak acquired 75% shares of Sean for 13,500 crores. He already got a 25% stake, and then he acquires another 75%. The fair value of the 25% stake already owned, that is PHI, is given, and the fair value of the net assets are given. How should such a business combination be accounted for in accordance with the applicable Indus? I think that makes it a good question indeed. So let me do one thing. Let me just, I think, first of all, organize my entries in a chart. So I'll just organize my inputs in a chart. Now, what I'm looking at again is the impact of this in terms of step number 4 and in terms of step number 7, pre-acquisition, post, everything. So let's consider the step number 4, and we'll divide the step number 7 in 3 parts. So let's see the impact in terms of step 4, the impact in terms of step number 7, and this is pre-business combination, this is date of acquisition, and this is post-business combination. Okay, so in this particular case, we very clearly know the case. I guess if you look at the case, this is a case of significant influence to a case of control. So just to connect the dots, earlier it was the application of Indus 28. Now it's an application of Indus 110, or call it 103, irrespective. Okay, so let's first of all see the impact of the PHI. So this is the impact of PHI. So very clearly we are given in the question in the last sentence, the fair value of 25% interest is owned is supposed to be 4860. So we will take the figure of 4860 as a part of PC. So we will take the fair value of the PHI as a part of the purchase consideration. That's one. Next, on the pre-business combination, there are two things to be done. So what is the book value as per equity method? So the book value as per equity method is given to me. It is 4779. This is the book value as per equity method. And we know the fair value. This is 4860. So we compare the book value as per equity and the fair value. So the difference goes in P&L. So 4860, 4779, that's 81. So the entry becomes investment debit and profit and loss gets a credit. And this is to the extent of 81. This is one entry done, comparing the book value and the fair value in this case. Next, number 2. The second input, what we need to take here is the scrutiny. Is the scrutiny of the accumulated OCI balance. So let's make a scrutiny of the accumulated OCI balance. So we are given there are two balances. One is the foreign exchange difference, FCTR. So one is that FCTR balance, and that FCTR balance is 54 crores. And this is a case of R. So we'll put the entry, and this is going to be taken to the OCI. So what we'll do, FCTR gets a debit and the profit and loss gets a credit. So this amount in the FCTR is going to be transferred in the profit and loss, a case of R. Then there is a revaluation surplus, which is a case of NR, and this is to the extent of 27. So this amount that is revaluation surplus will be debited and directly transferred in the retained earnings. So many times people got the practice of merging these entries with the acquisition date entry. I would say no, let's go split off is better. So two tasks are there in front of you. The book value and the fair value gap is taken in the P&L. The scrutiny of the OCI, which is R, is taken in the P&L, which is NR, is taken in the retained earnings. Then let's go to the acquisition date. So in terms of the acquisition date, we are given in the last para, it says that the fair value of the net assets is 16,200. So the acquisition entry, net asset gets a debit, 16,200. And the purchase consideration will get a credit. Now, what is the PC? 75% shares acquired at 13,500, and the PHI updated at 4860. So this is the fair value of 25% PC, and this is what he paid for the 75%. No NCI. So 13,500 and 4860, 18,360. So you get a difference in this entry, that is goodwill. So 2160, that becomes the goodwill as a balancing figure. There is no NCI in this case. And I think that's it. Nothing else is given. So nothing to be done in a post-business combination impact. So I think the clarity of thoughts which you should achieve in a step number 4 is a linkage in terms of the step number 7, most crucial. That when you take the impact of step number 4, you should be clear that whether it's a part of PC or not, at what value, that's one. And then when you go ahead in terms of step 7, what is the impact before the acquisition entry, 3? Is there any impact on the acquisition entry, 2? And is there any impact on the post-acquisition business combination? DC goes for unwinding in a post-business combination. CCS goes for the impact if the financial liability is FPTPL. CCE goes for impact of Ind AS 102. And in terms of PHI, no impact on the post-business combination. The impact gets over simply pre-business combination itself. Right, so that was another agenda. Let's go to the next one now. So we've done DC, we've done CCE, CCS, TC, PHI. Now the sixth agenda, share-based payments. So let's consider another mind map. And once you've done all this extensively, sit down and do a comprehensive practice in terms of these things. These mind maps, once you practice, you can enhance them at your own levels as well for a better picture for your own mate. Tailor them for your own needs so that everything is there in the mind maps. You can keep revisiting these mind maps before the exams, and everything comes naturally in that case. Revisions will make you help in terms of everything will start coming naturally to you in this case. Okay, now let's begin with the picture. So we're making another mind map, which is a part of the sub-step in step number 4. So we're making another one that is a mind map, step number 4. The focus is share-based payments, SBP. Let's connect the dots. Now, when you recall the concept of a share-based payment, what comes in the mind is that there are 3 cases in terms of share-based payments. The acquirer tells the employees of the acquiree in terms of replacing the original awards. Either it is mandatory, or it is, you can say, optional, or you can say he refuses to replace. So either he says, yes, it is replaced, mandatory, or he says replaced, it is optional, or it says no, I am not replacing them. So we've got 3 permutations and combinations in terms of mandatory, in terms of optional. So let's make a summary chart on this. So let's make a summary chart on this area. I think here again we should try to link the concept in terms of the step number 4 and in terms of the step number 7 again. So let's make a summary chart connecting the dots. So here we have got another interesting chart. The cases, step number 4 and the step number 7. So making similar kind of formatting for easy recall of the concept. So this we are taking the cases. The other one we are taking is the impact on step number 4. The other one we are taking the impact in terms of step number 7. That is on a pre-business combination, then on the date of acquisition, and then on the post-business combination. So as we said that there are 3 cases which we need to make a walkthrough on. It's a mandatory replacement, it is a case of optional replacement, or it is a case of no replacement. So we've got 3 cases. So let's draw a line in between. So we've got 3 permutations and combinations. One is a case of mandatory replacement. So one is the case of a mandatory replacement. Another one is the case of optional replacement. And the other one is a case of no replacement. Other one is a case of no replacement in this case. Okay, so this is 1 and this is 2 and this is 3. So we've got 3 permutations, combinations which arise out here. So now let's come to first of all the case where it is a case of a mandatory replacement. The acquirer is mandated to replace the awards which are given to the employees of the acquirer. So here you need to split between the pre and the post business combination portions. So we can say step number 4, we take as a part of PC, Just to recall the concept of proportionate figure. So what is the proportionate figure? You need to consider fair value of the original award on the date of acquisition and take a proportion. Vesting period completed upon the total vesting period or the original vesting period, whichever is greater. So in this particular case, what do? We consider the fair value of original award on date of acquisition. We take the fair value of the original award on the date of acquisition into vesting period completed. We take the vesting period completed upon the total oblique the original vesting period, whichever is higher. Whichever is higher. So we need to take a proportionate. We need to consider a proportionate value in this case. We take the fair value of the existing original award acquisition date and we need a proportion. The vesting period completed upon the total or original, whichever is greater. If it is a case of an optional replacement, in this particular case, can I say it's not a part of PC? So it's not a part of PC. And even if it is a case of no replacement, the same thing works as in the case number one. So in this case, we can say same as one. Whatever you did in point one, the same thing is taken. We take the proportionate fair value in this case as well. Now let's see the impact in terms of the step number 7. What is going to happen? Nothing in the pre-business combination. So nothing happens in terms of pre-business combination in either of these. And on the date of acquisition, you've definitely taken this as a part of PC. This is not a part of PC. And this is a part of NCI. Now here we need to be careful in this particular case, that in this particular case, it is a part of the purchase consideration. And in this case, it's a part of NCI. Because when you do not replace, then in those particular case, the shares will go to some outsider and the NCI will get enhanced at that stage. So looking into the fact whether it's a mandatory or there is no replacement will impact, whether it's a part of PC or NCI. Then in a post-business combination, we can say we will apply Index 102. We will apply Index 102. And to which portion? So we will take the fair value of replaced awards minus the value which was a part of PC minus the fair value part which is a part of the PC. So we know the fair value of the replaced awards minus the fair value which is taken as a part of PC. In this case, the entire fair value we apply Index 102. To this entire we apply Index 102. And further, when you say no replacement, in this particular case, again, we can say we apply. So I think let's put it the same as case 1. This is again same as the case number 1. What have we done in case 1? Same will apply. So that makes it a good summary chart in terms of things. I think let's do a question on this area as well. Then the only part which will be left over is the pre-existing relationship, which has got some more complicated issues, but effectively our step number 4 will get over. Let's do another question with you on this area. So let's have a look at a question number 4, which is there in the education material. Similar questions, of course, in the study material as well. So let's look at the question number 4. Let's read the facts of the case. It says on 1st April 2014, it says company ABC granted equity settled share-based payment awards with a granted fair value which is 1 lakh to its employee, which is subject to 3 years condition. The company XYZ acquires the entire shares of ABC, and as a part of the acquisition agreement, it is required to issue. The word is very clear. It is required. When it says required, it indicates basically that it becomes mandatory in nature. So it is required to issue equity settled awards to ABC employees. At the date of acquisition, the market-based measure of the original awards is given. The market-based measure of the replace awards is given. The replacement award has got a 1-year vesting condition. Originally, the awards were given for 3 years. The acquisition took place after another 2 years' time, and the replace awards have got another 1 year of vesting condition. Determine the amount attributable to the pre-business combination and the post-business combination service in a situation where all the employees are expected to meet the service condition. So I think let's consider this. We'll look at the impacts in all the angles. So I think let me make a little chart again to give the full connect. This is undoubtedly a case of mandatory replacement. So we'll see the impact the way we have seen earlier. Pre-business combination and this one. So this is a case of mandatory replacement. This is a case of a mandatory replacement. So we're looking at the impact on step number 4 and the impact in step number 7, pre-business combination, date of acquisition, and post-business combination. So let's look at the permutations combination. So we first look at the case. It is undoubtedly mandatory replacement. Undoubtedly a case of mandatory replacement. Now, in terms of the step number 4, we need to consider the pre-business combination portion is a part of PC, and the post-business combination portion is going to be accounted under Ind AS 102. So we'll, I think, split the calculations. This will be PC and this will be 102. Now, we pick up the fair value of the original awards on the date of acquisition. That's 180. Into the vesting period completed is 2 out of 3, 2 years completed. And the original or the total vesting period is again 3. So that comes to 1,20,000. That's a part of PC. And if you look at the fair value of the replace award, it is supposed to be 2 lakhs. Out of this, 120 is pre-business combination. So 80,000 is the post-business combination. This is the fair value original award, and this is the fair value of the replace award. So from this, you reduce the pre, you get the post-business combination. Now let's see the impact in terms of the pre-business combination. No impacts. As a part of the date of acquisition, can I say we take the part of purchase consideration? This 1,20,000 is a part of the PC. And in terms of the post-business combination, we can say we will account for this remaining 680,000 as a part of Ind AS 102 in the post-business combination. So I think once you give the connects to the examiner in terms of these permutations combination, you tell him clearly that this is pre and this is post, this is a part of the PC, and this is accounting under Ind AS 102. Trust me, you send signals of your clarity of thoughts to the examiner. So I think my inputs in terms of the issues relating to PC is done, except one, which is, a little lengthier one to discuss, but we have discussed the concept of DC, CCE, CCS, TC, PHI, SBP, and now we just got pre-existing relationship. So that we'll discuss in the next class with you. And we'll also, as far as step 5 and 6 is concerned, easy, we'll do some comprehensive questions on this area in the next class with you, combining all these steps and a larger, bigger questions, smaller questions done. So I think that's all seems to be good for the day. So please revise this. I'm going to join you back tomorrow morning. So we'll continue with the trail of thoughts. That's all for the day, friends. So thank you very much. हाँ जी, ओवर कर दीजिए। हाँ जी, thank you. Same to you.